welcome to the Opus Wealth Style Podcast. I'm your host today, Evan Wohl, joined with my trusty companion and partner, Iván Watanabe. Iván, how you doing?
I'm good, man. How are you?
Awesome. Got my trusty new computer zooming in and out on me. And joined today is a good friend and old friend. We go way back. Mike Nulty, who's a CPA, and we wanted to get him on here to talk about some tax strategy, and we'll dive a little deeper on some things that that you see or don't see that might help people just be in a better situation from a tax perspective. So, Mike, how you doing?
I'm doing pretty well, Evan. Thanks for having me.
Yeah, absolutely. Well, Mike, if you wouldn't mind, maybe tell our audience a little bit about yourself, your practice, the different aspects of it, and then we'll dive in a little deeper.
Sure, absolutely. So I'm Mike Nulty, a partner in Matthews Nulty. We're a CPA firm located in East Brunswick, New Jersey. We do all different, assortments of accounting work. We do personal tax, business tax, audited and reviewed financial statements, monthly consulting, and bookkeeping work. We handle all different types of businesses and personal work. Our four main areas, though, when it comes to the business end of things, is construction, restaurants, nonprofits, and IT consulting. Those are kind of our bread and butter when it comes to the business line of work that we do.
Got it. And so what would you say is the breakdown between individuals versus business owners, just to get a sense as to that?
Sure. So as far as like a breakdown of percentage, from a revenue standpoint, I mean, the personal income side of things is probably about 30-35% of total revenue. The business end of things, obviously that's a little more lucrative. So a lot more work comes with it. Obviously monthly financial statements, business tax prep, information for banking purposes. So the fees are a little bit higher on that end. But it's a pretty good mix between, business and personal.
Got it. So when you think about both the business side and the individual side, what do you see as some of the common mistakes, again, on both sides?
The most common mistake that we see is poor record keeping, especially on the business side of things. A lot of business owners, especially small business owners, it's left pocket, right pocket, all same pot of money. So as far as delineating what's actually business and what's actually personal in their lives, it's all one big blend. So typically what we do is we really try to relay to the business owner that you really got to keep a separation between what's business and what's personal. So what we typically advise clients to do is to make sure that everything's segregated. You have a separate bank account for business. That business account will pick up all business revenue, all business expenses, and obviously, money that's needed for personal living is pulled from that business account to that personal account. Try to keep things as clean as possible. The IRS, if there was an audit, would typically try to blend both. It could be tough if the records aren't good, well kept, that the IRS could start saying that some of the personal income is really business income, and it could be a tough situation.
Got it.
Yeah.
Are you so if you're an individual or maybe a small business owner, are there ways or things that you're recommending that they do keep track of their expenses? Is it, make sure you also have a business card versus a personal? What are the sort of like small things that folks can do to keep track of their stuff?
Yeah, so the two big things is obviously having a business bank account, business credit card. What's business is business, what's personal is personal. Sometimes the lines can be blurred, but you want to keep it as clean as possible. And the next thing is really to document your business receipts and your business revenue. Whether that's using a software like QuickBooks or even if you just put it on Excel, to make sure that all your expenses are delineated and properly documented. That can save you a lot of money in the long run.
Is QuickBooks what you often recommend?
So QuickBooks is a good software. Is it a one fit for all? It depends on the business. For most small business owners, it's suitable. There are some limitations to QuickBooks. Obviously, if you're looking for certain like cost analysis, things like that, there is some limitations with the software. But if you're a small business that is really just selling, one type of product, it can really work wonders for your business. Because the big thing that business owners really run into is they don't really know their numbers. How's my business doing? They wait until the year's over. It's very difficult at that point to really come up with strategies. A, figure out how much they owe, but also B, bring down that tax and try to minimize that tax burden. If you're working with someone and or have books throughout the year, it's relatively easy to at least game plan and engage in how much tax will be due. So most business owners, especially in the small business world, are more reactive than proactive. We try to emphasize to our clients that you really should be proactive. You should, take a look at your numbers. If you can't read the numbers because, sometimes reading a financial statement is difficult for business owners, that's where they should, hire outside help to help them review those numbers.
And you think like a quarterly review those numbers?
So we like to do it on a monthly basis just because on a quarterly basis, you're already 3 months behind. Now, from a tax standpoint, typically most business owners pay taxes on a quarterly basis. We really want to see how the business is doing on a monthly basis. Strictly from like a revenue and expense standpoint, you want to be able to pivot and make decisions quickly. If you wait till the end of the quarter, you could be 3.5 months behind, and at that point, depending on the size of the business, maybe too late to adjust.
Got it. Are you, and with your planning, are you having conversations with folks about sort of what would be a capital improvement or a capital expense? Or is it simply, and wanting to reinvest back in the business for future planning? Or are you more saying, hey, listen, we need to try to reduce the tax liability, and here's kind of the ways we're going about doing that?
That's a great question. So what we tell clients is you should never do anything just for a tax deduction. It should always be financially make sense. Like for instance, going back to your question, for a capital improvement, you can go out and spend $200,000, and that's great. You have a huge tax deduction, but that may not be the most financially prudent thing to do. So, do you really need that piece of equipment now? Is that really going to benefit your business in the future? Those are the questions and conversations that we typically have with our clients.
Yeah, it's funny because especially nowadays where, people are getting their tax advice from TikTok. You see these videos of people saying, I'm gonna buy a new car as long as it's over the pound threshold. I'm gonna buy a new car every year, and that's gonna be my new tax strategy. It's like, well, I don't even understand why you would. I mean, I understand that the tax quote unquote benefits of doing something like that, but that's just blindly, implementing these strategies without the sort of financial impact of what that really means, right? And it's, I'm sure you're battling that on an ongoing basis.
Oh, absolutely, yeah. Like obviously, no one wants to pay tax, right? Myself included. But a lot of clients, to your point, will say, "Okay, I'm going to buy a new car." Okay, so you spend $60,000 on that vehicle. That's great. It saves you $20,000 of taxes, but you still spent 60 grand. And what a lot of clients don't realize is once that initial hit, as far as depreciation is taken, now they have the cash outflow servicing the potential debt.
Right.
Which, you're kind of paying tax on that money at a later date because you're only receiving the deduction on the interest. So all of a sudden, that's great. This year you got a huge deduction. 2 years from now, once that depreciation interest is dried up, now you're paying tax on money that's going out the door. And we really try to tell our clients that, again, it's really got to make financial sense. Is that asset going to produce more revenue for you in the future? If so, then you got to really take, really seriously consider purchasing it. If you're looking to save tax money, well, sometimes it's cheaper to pay the tax.
So nobody wants to get audited by the IRS. This sounds like an absolute nightmare. What are there strategies that you talk about to minimize the chances of getting audited, both on the individual and business owner side?
Yeah, so I mean, it's typically what the IRS or what the IRS does as far as audit. It's kind of based on what's called a diff score. So what that diff score is, it's based on, one's for the personal and adjusted gross income compared to their deductions. Obviously, it's not 100% science. You just want to make sure that those deductions are aligned to your income. A lot of people would just try to deduct everything underneath the sun. Deductions won't really make sense to the income. And all of a sudden, 6 months later, they're getting the dreaded letter from the IRS. So, what we tell our clients to do is really just, if you have an ordinary necessary business deduction or personal deduction, really just back up that deduction with documentation and make sure that documentation is, readily available and stored securely, so that if you have to produce it, you can come out the other side in case there is an audit.
Yeah, it's funny. I've had folks say, well, can't I just create an LLC with no income and write off all of my expenses? And, I just, again, I think on our side as well, we're just battling a lot of these ideas that folks are coming up with, are getting sent to their inboxes through, TikTok and Instagram. I mean, social media is really like driving a lot of these, I'll call them ideas. But there has to be a justifiable income. And how do you think the IRS kind of does that, Mike? Like, can you show negative income for a couple of years, but at a certain point, like, this business needs to generate some sort of cash flow now, or be net cash flow positive in some way? Like, how do you justify it?
Yeah, I mean, we see that all the time too. Like, hey, I'm going to create an LLC to take expenses. Well, what's your business? Well, I don't really have one. Well, that's a recipe for disaster.
Mhm.
Yeah, I mean, at the end of the day, obviously, if a business is starting out, you're more prone to losses, because there's a lot of, ramp up time and money that goes into that business. Um, you just got to be careful as far as showing those losses, because the IRS could say, are you really in business to make money, or is it actually a hobby?
Hmm.
At that point, you could have some other issues. As far as like the number of years loss can be taken, I mean, there's like an old school thought of, you can take losses for the first 5 years. Um, that's not necessarily true. I mean, the business has to be progressing, and there could be legit reasons why there's losses. I mean, obviously, if you're reinvesting into the business early on, you're taking a lot of depreciation, and yeah, that may make sense why there's continued losses, because you're obviously building, reinvesting and building into that business, building up that business. Excuse me. Every business is kind of standalone. You got to look at each individual case and to see if the numbers actually make sense.
Hmm.
Um, just to make sure that you have no issues with the IRS or state agencies.
And when we're having conversations with individual clients, or maybe business owners also, one of the sort of favorite moves from most CPAs is to fund or their pre-tax retirement plans,
Mhm.
and allocate dollars to either a SEP IRA or a 401k or an IRA. And as we kind of go through our planning with clients, we're trying to evaluate sort of the short-term benefit, I'd say, versus a long-term kind of like, what do we think the impact is on their retirement cash flow, depending on how that money is going to be taxed on distribution, right? So should we be funding a pre-tax 401k or a Roth 401k? Or does it make money, as you were saying before, you've got to shell out X amount of dollars, but you'll save X on taxes today, right? So what's that sort of fine balance? Most of the time, we're recommending the clients sort of fund IRAs around tax time once they get an opportunity to see what the previous year's taxes will look like. Are you sort of recommending folks fund those retirement plans ahead of time? Are you doing projections for clients? How can people sort of be more proactive, as you said, than reactive with their retirement funding?
So we tell clients to do typically, if they can fund the retirement throughout the year, that makes a little bit more sense from a cash flow standpoint. Some clients will just wait, like you said, until the year's over to make that contribution. They want to see where the numbers shake out. Every situation is a little bit different. And some people, is putting the money in the retirement account. If I put away $10,000, that saves me $3, but now I locked up the 10 grand. So all these scenarios got to kind of be spoken about with the client to make sure it makes sense. What are you looking to do in your business, right? So I put away $10,000, that saves me three grand taxes, but I really need the $10,000 to buy a piece of equipment that I know I'm going to need, 8 months. So okay, so maybe you eat the tax, pay the 3 grand to buy that piece of equipment that will make you more money in the future.
Yep.
So you really try to, at least here, we really try to get our fingers on the pulse, especially with the business clients, to kind of have those conversations to figure out in your particular situation what makes sense to do. And you want to give the client as many scenarios as possible, because again, some people are like, I don't want to pay tax no matter what. I'd rather put money into retirement. I'd rather, buy vehicles, whatever can be done to bring down the taxes. Some people will say, you know what, it might be a little more financially prudent this go around this year to pay the tax, because I know I'm going to need more money in the future to help my business grow.
So Iván, I don't know about you, but I'm sure this is the case for you as well. I've got a lot of clients that always want to invest in real estate to some degree. It's at least a goal that is in the short term, and then it's first piece of real estate, second, third. Mike, how do you think about, or how do you speak to clients about the possible tax deductions from investment expenses or interest? And then is there a specific business structure that you recommend for just individuals who are starting to accumulate some real estate? Is it always LLC, or is there, what are some other factors to consider there?
So for clients that are, that's the big thing. People, want to invest in real estate. They think that investing in real estate, is going to be this huge tax savings. What a lot of clients don't realize is it's not one size fits all, right? So certain times, what a lot of clients end up in is that, hey, listen, I bought this, this rental property, but because of my other income and I'm not materially participating in the rental property, I can only deduct so much. So, although real estate has a lot of tax advantages, and as far as pulling cash out, refinancing, things like that, for some people, it just doesn't necessarily have the immediate tax effect that one would think. From an entity standpoint, typically a LLC is the way that most people go. Some clients, depending on how big their portfolio is and how many properties that they own, they would want to own each property as an LLC and then have one main holding company. Now, whether that holding company is an S corporation or a partnership, depending on how many partners they have, from a simplistic standpoint, as far as filing, a lot of people are just multiple properties. We just have one holding company to file one tax return for all those properties, which kind of makes it a little bit easier as far as planning, because everything rolls up into one entity. And you can have one property that has, a gain here, one property that has a loss to kind of offset, that taxable income.
Yeah, can you speak to a little bit more to I think the real estate piece is important for the listening audience. Just, how much time somebody needs to be spending within their business to get sort of the maximum amount of deductions, right? I mean, I know a lot of it has to do with it not being a hobby or just owning a piece of this real estate, but actually spending some dedicated time there. What are the rules, or how do you sort of make the case that somebody is sort of I think the term is like a real estate professional, right? Is that sort of the designation that somebody needs to generally have for this?
That's correct. Now, real estate professional, a lot of people think that would be just like a real estate agent, right? So that's not necessarily true. Are you materially participating in the real estate activity? So what does that mean? That means that based on the number of hours, am I materially participating on it? So if you have a full-time job, that you're working 40 hours a week and you own one rental property, it'd be very difficult to prove that you're materially participating, in that rental property. Typically, the rule of thumb is about 1,200 hours a year, right? So are you spending 1,200 hours a year on real estate? If not, you might have a difficult case to prove that you're actually a real estate professional. Now, if you have multiple properties and you're managing those properties, that's a little bit of a different situation if that's your only source of income, because obviously you're materially participating, in that activity. What a lot of people don't realize is that I got a full-time job, I'm making $200,000 a year, I decide to go buy this rental property. What do you mean I can't take those losses to offset my other income? Well, you didn't really materially participate in it. You're still working 40 hours a week making $200K somewhere else. So those losses become suspended. So that's sometimes a big teachable moment for clients that, again, going back to your point, I saw this on TikTok, how great real estate is, why it's a really good investment. Just sometimes the immediate impact isn't there for everybody.
Right. And so that, I mean, if, on top of that, right, if you're using a service to actually manage the properties, right, and they're eating in a little bit into your profit there, to your profit margin, then you have even less of a case, right, that you're a quote unquote real estate professional. So, I again, teachable moment, and I have this conversation, I feel like more often than not, around what the real value of that piece of real estate is. Again, there's other ton of benefits, right? But this particular one, I think, often gets oversold in social media. When you actually start to break down how you qualify, it becomes less and less and less of a viable thing for working professionals.
Absolutely. I couldn't agree with you more. Yeah. A lot of people think, I have all these losses, I can use those losses to offset my other income. But if you run to passive activity loss limitations, you don't have it. But again, going back to the point you just made, the long-term play and the other value that it's creating, obviously is good as well. I just think that the immediate impact is kind of lost in the sauce. People think it's better than what it really is immediately.
Mm-hmm. Mike, are there, just as we're wrapping up here, are there kind of things that you find yourself repeating over and over again to clients that, or as you're, meeting new people, both again on the individual or business owner side, that you think this would be helpful for kind of everyone to know and understand as it relates to managing their tax situation?
So the big thing that we really tell clients, and I had this conversation multiple times a day, is really just try to keep the records clean. Meaning that, especially for small business owners, lines get blurred. They think it's just one giant pot of money. But anytime you have an entity, you got to really keep that stuff separate. If not, and there is unfortunately an audit, it could be really difficult because the burden of proof is not the government. It's on you to prove that these expenses and this income that you're receiving, either is income or not income. And unfortunately, we see it far too much that it can be difficult to really prove that because records are either were never kept or misplaced or just in disarray. So that's why it's so important to make sure that you have all your ducks in a row. You have either a professional set of books, whether that's done internally or externally, to make sure that all the flow of money and both revenue and expenses and transfers and everything else is kept clean.
Are you seeing more or less audits, about the same? Like, what's your experience?
That's a very good question. We have seen an uptick in audits, yes. Obviously, during COVID, things were a lot slower on the audit end. The IRS was, closed or hampered, due to COVID. But we see a lot of business audits, uptick in business audits, but we also see a lot of upticks in state audits. So most business people are really just worried about the IRS. The IRS is actually just one component. I mean, typically these states, especially, you know, the ones that have some budget issues, are really going after business owners, whether it's sales tax or payroll tax. And a lot of these audits can actually have worse outcomes on the IRS just because they have longer statute of limitations, and the burden of proof and the way that the states take a look at expenses is actually a higher threshold than the IRS. So that's something that we're really telling clients to make sure that their documents are, you know, are in good shape. Also, the other thing that we're really seeing a lot of audits, a real lot of audits, is Department of Labor. As far as, like, you know, what's an employee, what's not an employee, based on control. You know, is that really a 1099 employee or is it really a W-2 employee? And these states are really coming after you know, these business owners regarding that.
Got it. Are you seeing a lot of, I mean, you know, in our area in the Northeast, right, in New York, with higher volume of people moving out of state and trying to claim residency in other states? Are you dealing with a lot of that as well?
Yeah. I mean, especially if you're leaving like New York, New Jersey.
Yeah.
You go to Florida. We tell clients that, you know, just say they move from New Jersey to Florida or New York to Florida, like, just be ready, the letter's coming, no matter what. Especially on the New York end, you know, they're really looking into clients that move out of state, and, you know, and rightfully so, right? Obviously, there's the state's economic benefit. Who is that really going to? Is it really going to the state that the work's being done in, or the state that they're currently living in? And just making sure that you have that clean break when you actually leave, to say, New Jersey for Florida. You know, make sure that you changed your driver's license. You know, you change the place that you'll register to vote in, because all this stuff these states are really looking into, because obviously they're looking to collect the tax money.
Yeah. Well, Mike, we really appreciate the time. If our audience out there is looking to hear more about you and your practice, where's the best place for them to check it out?
Yes, they can check us out at matthewsnulty.com. On there, obviously, we'll have all our services and our contact information, and we're happy to help in any way we can.
Awesome. Well, appreciate you coming on, and good catching up. We'll chat again soon. And to the listening audience, thanks for tuning in. Please like, subscribe, give us a 5-star rating if indeed we earned it, and we'll review every one of them. So till the next time, have a good one and speak to you soon. See you guys.